calculating intrinsic value to find stock market gems like billionaire Warren Buffett. Today, we're diving into a topic that might sound a bit intimidating, but trust me, it's not as complicated as it seems. We're talking about calculating intrinsic value, the way Warren Buffett does it. But don't worry, I'll break it down in simple terms that even your grandma would understand. So what exactly is intrinsic value? Simply put, it's the true worth of something. Not what the market says it's worth, but what it's actually worth based on its fundamentals. Imagine buying a car. The price tag says $20,000, but you know its engine, parts, and condition make it worth $30,000. That extra $10,000 is what we call undervalued. Intrinsic value is like finding that hidden gem, buying a company when it's undervalued. Why is intrinsic value important? Billionaire Warren Buffett, one of the world's greatest investors, is famous for buying stocks when they're selling for less than their intrinsic value. He believes in finding great companies at a discount, like buying $1 for 50 cents. This helps him and can help you make money over time. How to calculate intrinsic value? A simple breakdown. Now let's talk about how you can calculate the intrinsic value of a stock. Here's a simple 3-step process to get you started. Step 1. Understand the company's earnings first. Look at the company's earnings. Earnings are like the company's paycheck. It's the money they make after all expenses. A key number to know is the earnings per share, or EPS. You can find this on most financial websites like Yahoo Finance, FinViz, and Morningstar. It tells you how much profit the company makes for each share of stock. Step 2. Estimate the future growth rate. Next, think about how fast the company will grow in the future. Are their products popular? Are they expanding? A good place to start is looking at how much they've grown in the past 5 to 10 years. Use that as an estimate for future growth. This number is often expressed as a percentage, like 5%, 10%, or 15% growth per year. Step 3. Discount to present value. Now, this might sound fancy, but don't worry, it's not too hard. The idea is, the money today is worth more than money tomorrow because you could invest it and make it grow. To find out what future earnings are worth today, we use a discount rate. Think of it like applying a sunscreen of 5 to 10% to protect your future cash from losing value. The formula, intrinsic value equals future earnings divided by 1 plus your discount rate, raised to the power of the number of years you're looking ahead. I know this sounds complex, but there are free online calculators that do the heavy lifting for you. You may also try to check out alphaspread.com, where it shows you whether a company is undervalued or overvalued. It has free and paid plans. Key things to remember and look for. Now, here are the key things to keep in mind when calculating intrinsic value, like Warren Buffett style. 1. Look for a moat. Does the company have something that makes it special? Maybe a strong brand, a unique product, or a loyal customer base. Buffett calls this a moat, like a castle moat that protects the business from competitors. 2. Check the management. Is the company led by people you trust? Look for a management team that is honest, capable, and has a track record of making smart decisions. After all, you're trusting them with your money. 3. Margin of safety. Always look for a margin of safety. This means buying a stock when it's priced well below its intrinsic value. It's like having a cushion in case things don't go as planned. 4. Patience is key. Investing like Buffett means thinking long-term. Don't worry about short-term price swings. If you've found a great company at a great price, time is on your side. So there you have it. Calculating intrinsic value simplified. Remember, it's not about being a math genius. It's about understanding the fundamentals of a business and making informed decisions. With a little practice, you can start spotting undervalued gems in the stock market, just like Warren Buffett. And as always, do your research and make sure you're comfortable with the risks. Thanks for watching. If you found this video helpful, give it a thumbs up, subscribe to our channel, and hit that notification bell so you don't miss our next video. And feel free to drop any questions in the comments below. I'd love to hear from you. Until next time, happy investing. The Shortcuts Hub.